Okay, everyone, welcome to the Art of TradeStation. I'm David Russell, VP of Market Intelligence here at TradeStation. It is great to be with everyone. All right, some people are trickling in. As they do, we're going to share a few things. One of them is the zip file. And if you open the zip, that has some information in it. So we're going to go ahead and do that. And let me just tell you there's one other link I want to give you guys. It just has some disclosure information. Okay, great. Well, it's great to be with everyone. Let's just get started. Okay, this content is for educational and informational purposes only. Any symbols, financial instruments, or trading strategies discussed are for demonstrational purposes only and are not research or recommendations. TradeStation companies do not provide legal, tax, or investment advice. Past performance, whether actual or indicated by historical tests of strategies, is no guarantee of future performance or success. There's a possibility that you may sustain a loss equal or greater to your entire investment, regardless of which asset class you trade, equities, options, futures, or cryptocurrencies. Therefore, you should not risk money you cannot afford to lose. Online trading is not suitable for all investors. Visit tradestation.com/important information for a copy of the document, characteristics and risk of standardized options. Before trading any asset class, customers must read the relevant risk disclosure statements on our important documents and informations page. System access and trade placement and execution may be delayed or fail due to market volatility and volume, quote delays, system and software errors, internet traffic outages, and other factors. TradeStation Securities Inc., TradeStation Crypto Inc., and TradeStation Technologies Inc. are each wholly owned subsidiaries of TradeStation Group Inc., all operating and providing products and services under the TradeStation brand and trademark. You Can Trade Inc. is also a wholly owned subsidiary of TradeStation Group Inc., operating under its own brand and trademarks. TradeStation Crypto Inc. offers self-directed investors and traders cryptocurrency brokerage services. It is neither licensed with the SEC nor the CFTC, nor is it a member of NFA. When applying for or purchasing account subscription products and services, it is important that you know which company you will be dealing with. Please visit tradestation.com/important information for further important information explaining what this means. Options trading is not suitable for all investors. Your TradeStation Securities account application to trade options will be considered approved or distributed for all investors. Your factors, including your trading experience. See characteristics and risk of standardized options. Visit tradestation.com/pricing for full details on the costs and fees associated with options. Any examples or illustrations provided are hypothetical in nature and do not reflect results actually achieved and do not account for fees provided are hypothetical considerations. These types of examples provided to illustrate mathematical principles and not meant to predict or project the performance of a specific investment or investment strategy. Accordingly, this information should not be relied upon when making an investment decision. Okay, great. So we're going to go through a series of different things here that kind of get us ready for earnings season. A lot of the big companies are coming out in the next couple of weeks, starting on Friday with some of the big financials. So it's a good time for us to be showing some of this functionality that is built into TradeStation. The first thing we're going to do is going to show how to find the earnings dates with some of the tools that are on the platform. Now, some of these tools have been, we've shared them in the past, but now we're disseminating them to all users. So that is an interesting opportunity for everyone to start learning. We also want to take a look at analyzing some of the companies themselves in useful ways around earnings season, using RadarScreen and setting alerts for after. And I'm also going to show some basic option strategies that might work for some people during earnings season. All right, so I'm going to share this the link again, and this link, when you open it, it's a zip file. You're going to see this. You're going to see this is an easy language document, Art of TradeStation Earnings Indicators. You're going to see a workspace. So you want to first import this, and you're going to see a dialog box like this. Now, I already have these included, so I'm going to cancel. But if you bring these in, they're going to then be used in the workspace. Once you've imported them, you can open the workspace and you'll see something looking like this. This document are the slides that I'm going through, and currently on slide 6. So just that's how it basically works. This is the main tool we're working with here, this next earnings date studies, it's called. So, all right. Now, Next earnings date RS is a new function displaying upcoming dates and times for quarterly reports. What it's going to tell us is it's going to tell us a few important pieces of information. It's going to tell us whether or not the earnings date is confirmed. As we get closer, the earnings dates start getting confirmed. We have rough estimates early, a few months out when companies are going to report, and then they start confirming those in press releases and on their websites and stuff. And as that happens, it then gets confirmed in our database. It also allows you to see the number of days for sorting to help you kind of sort in RadarScreen. Now, as you open this workspace, it has the S&P 500 loaded. It might take a little bit of time for all the companies to come in. You might have seen some delays and things with that. So this is already loaded on the workspace that you have. If you want to do this yourself, though, say you're like creating a new workspace or something, this is essentially what you would do. If we create a new workspace, and now, for example, if we go to RadarScreen, which is this tool here, say we just throw a few companies in here like Apple, maybe Tesla, Microsoft, and maybe Bank of America. So these are the normal sort of indicators that first pop up. If you go to Studies, Add Study, and then you go to Next Earnings Date RS, this is what it looks like. Bring it in like this. You'll see it populated, and there's the information. So that's essentially how you would add it to future workspaces on your own. Essentially, it's going to look like this in RadarScreen. Now, you can also view this in charts. This workspace I've shared shows the data right here. So if we look at a company like Bank of America, you'll notice that it's highlighted here because the earnings are coming up soon. And a company that reports further out like Apple or one of these, you'll see it gives the date, but it's not highlighted in a color. And those are some of the settings that are built into the actual indicator. So to modify some of those things, well, first I'll show you how to add it. Let's go here and do an apps. Let's go to chart analysis. Look at some going Bank of America, make it a daily chart. It's going to have a similar name. Go to Studies, Add Study. And then you're going to go to Next Earnings Date. It just has a slightly different name, Next Earnings Date Studies. And hit OK. And now it's going to populate. So we're now on slide 8. And if you want to make any changes to this, what you're basically going to do is you can right click on this and go to Edit Text. And this is a special thing that's done with an object. It's a special thing that's used in easy language. So it has a slightly different interface here. You just hit yes. And then what you actually do is you go to inputs and you can change these different settings here. So now if you go to our next slide, we're going to actually show you what each of these things are. And I'm going to just describe it. So if you just see the way this is, the key to this is on the next. All right. So you can set a threshold for coloring the nearby dates. So for example, if I wanted to see all the companies that, if I wanted to highlight it in a different color, like in this case, it's called orange red. It's called nearby earnings. I could change it to something like, 10. And then it would, or in this case, I'll change it maybe to like 30. Then it will tell me something like Apple should actually pop up then. So that's the first thing right there. How many days do I want it to highlight and tell me? The next thing is you can customize the different colors. So you can, the standard color is just a dark gray versus orange red. Those are the different colors you can customize it with. And the next thing you can do is to adjust right and left the position of the box, and then you can change the font and the font size. So for example, if I want the box to be more in the middle, I can maybe change that to 50. And let's just hit OK, and you can see what happens. The box moves over. And now if I look at something like Apple, it should also highlight. Remember before it did not. And then you can actually see there that it put it in this orange color. So these are some of the basic sort of ways to quickly customize it. The colors, something like that. You might use different colors in your chart. So you might want to use, different colors for this. And those are all the different ways you can do it. It's really basic, but extremely useful. So I wanted to just quickly show you how you can customize that. All right, that was slide number 10. Now I'm going to go on to slide 11. So let's look at some of the other studies that I have included in this workspace. Let's go back to my original workspace. Now, some of these studies are custom that you need to have that zip file for. This can be very useful, for a lot of different things. For example, the sector. I always like to kind of just have a sense of like the sector for things. If you want to see like upcoming technology stocks or something, you can sort by the sector, and that's always useful. I'm going to show you in a minute how you can do things with the actual sorting. But you can see it can be really useful to kind of cluster companies you might be interested in. Energy stocks, for example, have been active recently. Maybe you're focused on those. So looking by sector is useful. That's built into TradeStation and it's available to everyone. The next one here that we have is revenue growth. Now, this is a custom one that I created. It's very simple, and I've explained it in my fundamentals art of TradeStation. But it also allows you to sort. In this case, it's not just revenue growth; it's revenue and it's revenue growth. So you can see who are the biggest companies by revenue. There's Walmart and Amazon, and then you can also see the revenue growth. So the companies with the biggest revenue growth. Some of these are distorted because of reopening after coronavirus, but you have the cruise lines that dropped like near zero and came jumping back. So this is just the revenue growth. But I like having revenue growth next to revenue because you can see, a small number. When you see a big percentage gain, it's often distorted by the actual number or the base, as we would say. So just a nice way to kind of sort and look at that. Next, we have earnings growth. That can just be useful as well to have a sense of how companies have been performing. A lot of these things are also been somewhat distorted recently, just by some of the lingering effects of coronavirus. Then market cap's the basic one to sort by the most popular, or the largest stocks. The other one I created here that is useful, I think, is average options volume. This is a special one that I've created, but the nice thing about this is it allows you to set a threshold. In this case, I have it set so that it will highlight all companies that trade at least 10,000 contracts a day. Now, the reason I like that is, most companies don't trade that many options contracts per day, but the companies that do tend to be more liquid, and they also, we're going to get into some option strategies in a minute. Some of those might work better for option strategies. So say you're looking at, let's see the companies coming up in order of when they report. Okay, so now we're looking 2 days out, 6 days out. As I look down the list, I can quickly see, oh, okay, here's a company, TFC. That's the old SunTrust. It doesn't trade a lot of options, but it's right next to United Airlines that trades a lot of options. So you might just be able to quickly see. Another thing about this is you can screen out the companies that don't trade a lot of options. For example, you could just go to this list. You could say if it doesn't trade a certain amount, you could erase all the ones under a certain threshold, and then you can then go back and sort them. Another little trick you can do right here is you could just go and you go to data, to add a blank row, and then you can say, all right, these are all the companies that trade at least 10,000 a day. So now what I want to do is I'm going to sort them by the order that they're reporting in. And he's going to see very quickly, now we can look at our active underliers and we can quickly see when are they reporting, how are they coming up in time. So that is some of the ways you can use RadarScreen very quickly. It's kind of like Excel, but better. Okay. So the next slide is just an example of how you can do that, and it's called with label rows. This is actually a little screenshot of me adding a label row. You want to click on the symbol, go to data, and add label row. So what I like to do with this is, and I often do this for earnings season, I will then sort by week. It's always useful to kind of just plan for your week. So I'm going to sort now by how long till they report. The next Monday is it's October 17th. So I can say everything now, I can just go here, click on this and say data, add label row, and I'll just call it, October 17, for example. The next Monday is October 24th. So I can then go down here, I can look for the next one. I can just go to data, add label row, October 24th. Now, by doing this, you can also see I've broken these things up into weeks, and now I can sort within the weeks, which is really cool because let me just do one more week. We can do we go down. Well, let's just keep moving this. The nice thing is now within each of these groups I've created, you can now basically see who's the most active. You can then sort them by market cap. You can sort them. You say, hey, who are all the tech stocks that are reporting, for example, the week of the 24th. You can then go down and you can then quickly see who's on the list. We have like Apple and these other names are in here. So this is just a useful sort of way that you can use label rows to sort. Wanted to show that. And the way you do that is by right clicking on this, go to data, add, you go to on the symbol itself, you go to data, you go to add label row, and it will add a label row that you can then type in its name. How do we access a zip file? I could. Thanks for this webinar downloads and recording. Can you? Good. I'm just looking at the questions. If you guys have any questions, please post them in chat. We're using that. Okay, so now the next thing I want to show you is this can be useful for anticipating things before earnings. Very often, opportunities pop up after earnings. A company might rally on good news, pull back. They might drop on bad news, and you want to, trade the upside or the downside before, after the event. So we also have some tools here to do that, and this is the second indicator that I want to show you guys, or the second tab on RadarScreen with a series of indicators. These are all included in TradeStation, aside from EMA with alert on cross. That's a custom one that I created and added in the zip file. So we are now on slide 13, if you're following. So I'm going to now do something else just to illustrate this. I'm going to go to Window. I'm going to go to View. I'm going to go to Messages, and then I'm going to go to Message Center. And I want to show you something. This shows me when I have different things happening, and there's alerts generated. They will pop up in Message Center. So I'm going to quickly show you. None of these have alerts turned on, but they all have the potential for alerts. So I'm going to select, for example, this, and this. I'm going to right click, and I'm going to go to Alert, Enable Alert Once. Boom. And now you're going to notice that this populated with a whole bunch of alerts, and it's going to start telling us stuff that might have happened for any of these individual companies. So what I have this set up to do is this will set an alert. So a company like Valero, this is now set up to alert when it touches the 21-day exponential moving average, which in this case it did. So it triggered an alert. You can see it's red there, and this is the custom one about EMA. The one built into TradeStation for moving average exponential will tell you when the moving average changes direction. It will send an alert. I wanted one when it touches the moving average, so I created that one, which is called EMA with alert on cross. You also have things generated by Bollinger Bands, which are illustrated by these. I changed them on this workspace to be black and white dotted lines, so they wouldn't have colors and confuse with the moving averages. So if we actually look here, for example, at something like Bollinger Bands, it will tell us that Verizon crossed over the lower price band. So for example, something like Verizon. Now it's also interesting to look at the benefits potentially of using some of these alerts. There are some historical examples. Recently things have been trading very much by this focus on the Fed, but there are times, maybe not now, maybe another 3 to 6 months, when people start focusing more on individual company dynamics. So I wanted to show you some potential ways that you could see, that this could potentially work. And I wanted to go back to August. On semiconductor in August, if you look back right there on August 9th, it had a strong earnings report, which was, I actually know the date of the earnings report, but somewhere along here, had a strong earnings report. It pulled back, touched the 21-day exponential moving average. And actually, the earnings were on August 1st. So it was right around here. You had a bullish earnings report. The stock rallied, pulled back, and you would have gotten an alert based on the 21-day exponential moving average right there. Another one, for example, was Enphase Energy. It was a solar energy stock on July 26th. They reported strong earnings on July 26th, which is right here. Stock rallies, and then you basically got on later in August and early September, you had some bounces at the exponential moving average, and then you also had come down and touch the Bollinger Band. So you would have had an alert from the EMA with alert on cross right here, and you would have also had an alert based on touching the Bollinger Band here. And both of those could again given potential opportunities for bounces. Another example was AbbVie in November of last year. This stock had a strong earnings report on November 1st of last year. Right here, the stock gaps higher. And then 3 to 4 weeks later, it pulled back and it touched the Bollinger Band right here and the 21-day exponential moving average. So this is an example. This is kind of what it's really kind of intended for. This was back when a lot of stocks were still trending before the big macro focus on the Fed happened. You basically have the stock rally, period of consolidation, and then the alert and the continuation. This is a classic example of how I look to use things like the exponential moving average and this sort of alert. So the thing is, earnings season happens. You find a bunch of stocks. Wow, this one's good. They had good earnings. You read something about it, but you know what? It just rallied. What do I do with it right here? It might pull back or it might drift, and you can put it into, this into this sort of radar screen, and then it will watch it for you. And it can tell you weeks later, a potential opportunity might have occurred. If you want to set an alert at a simple level, you use last, you double click on it, and then you set an actual level where you want it to pull back down to a certain level. Or if you're looking for something bearish and you want to see it rebound up to a certain level, you set the high or the low. So you use last for setting simple prices. You might also want to set an alert if it, say it drops, say you're bullish on a stock and you say, I just want to wait for, a day when it's down like 2% or something. You can also set that using using the net percentage change. You would just say, you can set this to say, I want to be notified when it pulls back at least 2%. You could go here and set to -2, or, +2, for the high alert versus the low alert. So that would be the up and the down. So all of these are ways when you see stocks reporting that you can then go and monitor them after the event. The other thing I wanted to mention, I don't have it on here, but I did want to show you is volume. Another study you might want to consider is volume average. So if you go to volume, you go to studies, add study, and then you go to something called volume AVG. The nice thing about this is that you can set a threshold based on the company's historic volume. So a company like, let's just go back up the list. Like Apple, it averages 82 million shares a day. So if you want to say, hey, I want a day when Apple is trading an unusual amount of volume, you can then go to this. Let's just set it like for a name like Apple. We can go in here. You can set your threshold to alert percent. That's set at 50. So it means if it goes 50% above the average, it's going to alert. You then go to alert, and then you say enable alert, and you can say like enable alert once. And then when that happens, boom, it's going to pop up. So the nice thing about doing it this way is it's going to keep track for each individual company, and it's going to calculate based on the number of the history. The input in this case is also the average length. It's looking at 50 days of history. You might want to change it to 1 month. That would be trading days. So you'd set it to like 21, for example. And then what you'll essentially see with that is you see that number change a little. It will then say if this volume is at least 150% of this number, it'll send an alert. So that's another sort of way just to stay on top of things. Usually after earnings, volume is not as useful because usually you have more volume on the earnings and then you're not going to get a high volume day, based on history after that. You could set it to a very short interval, like maybe a 5-day trailing history. I don't usually use the volume alerts that much, but I want to point out to you guys, if you want to do it, volume average is another tool that can be pretty useful. Where can I find recordings of this session? This session will be on our YouTube channel. Another question: how do I alert one moving average crossing another one? Well, that is not something we're covering today, but there is a way that you can do that using, I'm just going to open a new RadarScreen. If I go to studies, add study, and then you go to moving average, two lines, there is a way in here to set up an alert when moving averages cross. So I wanted to let you know that would be another way you would do that. You would use a completely different study. Going to keep going. How about when a stock is above the VWAP? Well, these are some other things that are, it's funny, I'm actually right now working on some other indicators for that, and I'm hoping to have them in a future art of TradeStation. So you know what, I'll tell you, just stay tuned, and that information will be coming soon. A lot of that stuff definitely is available, but it's not something that right now we're going to be able to cover in this webinar. I now want to turn to some option strategies. Okay, so we want to launch our OptionStation Pro tool. First, I'm going to close my message center. I want to make sure everyone just saw how to use message center. It can be really useful because, say you have 10 stocks that have good earnings. You put them in your in the second tab, which I call post EPS alerts. So you might be like, oh wow, I like Pepsi had good earnings, and maybe I want to, I don't know, maybe Ford or just something. You put them in here, and then you just enable these alerts by right-clicking on them and going to alert, enable alert once or whatever. And then you can just, at the end of the day, or sometime during the day, you can just check your message center and it will tell you what's happening. So this is just a way you can kind of use this to stay on top of the market, regardless of whether or not you are, you're at your desk. Just using message center in conjunction with some of these alerts, it can be a pretty powerful way to monitor quite a number of stocks and quite a number of technical indicators very easily. So now what we want to do is we want to look at OptionStation Pro. So you're going to go to the apps menu and you're going to look for this like paper airplane image. It's called OptionStation Pro. I'm going to apps. Here it is, and I'm going to launch this. Now, because the market is closed, I created two imaginary positions. This is a simulated trade account. You see here, all this information is simulated. So I created two different positions that I want to share with you guys. First, I want to show you OptionStation Pro. I mentioned you launch it from this icon here in the apps menu. By the way, you can move these things around, so some of yours may or may not be in the exact same place. Now, I want to show you something important about this. You're going to notice that I have this thing called magenta. Well, this is symbol linking, okay? You'll notice this is set up for, this is magenta global symbol linking, which this is set to magenta global symbol link. So what happens is if I click on a stock here, it will change the underlier in OptionStation Pro. So it changes to the, what is this, Union Pacific Railroad. If I click on Delta Airlines, you'll see DAL changes up there. It also changes the chart. So this has magenta. This has the magenta, and this has the magenta. You'll notice it's global. You cannot use, there's also local. So I could do green local and put this on green local. When it's local, it means it will only work inside of the same workspace. If it's set to global, it can work in multiple desktops. So sometimes you might want to, for example, and this can work with charts, you might have a radar screen in one desktop and then a chart in another desktop. I sometimes do this when I need to look on a lot of different monitors. I'll just go up here and I'll go to File, and then I'll go to New Desktop. And then when I do that, I'm able to create another chart, and I can have my radar screen on one, or my ordering, my trading controls on one, and my chart on another. So it's just another way to do it. A lot of people know about symbol linking, but it's cool to have the global symbol linking, which is what we're using here. So we're going to look first at the vertical spread. This is a classic option strategy, and I have one in place here on Apple. So right here is my OptionStation Pro. Here's an options chain on something like Delta, and it's set up right now to, I'm going to set it just to, it's set to single options. So if you wanted to trade vertical spreads, you'd go to spread, and then you would change to vertical. So just, and I'm going to explain what that means, but this is the control you're going to do here in OptionStation Pro. Up here, you can control the type of option strategy. And a single means you're just looking at individual calls and puts. Like if you want to just buy Delta calls or puts, it would be right here based on this. If you want to buy, you can just click on the ask, and it will assume that you're trying to do a buy, and then vice versa on the bid. And this is how you would do, calls on the left, puts on the right. Very simple to just navigate to those. If you want to do the vertical spread that we're going to go show first, again, you make sure you're clicking on this where it says spread, and you're going to change it to vertical. Okay. So a vertical spread is especially useful, can be especially useful in earnings season, because it can control a binary event very simply. Someone could buy Apple shares before earnings. So let's look at Apple. And we can see here that, a stock like Apple is, so the earnings are on the 27th. And, there's significant risk if it jumps against you. A stock can make a big move before or after earnings. It can gap. And if you own the stock, it can be very expensive and painful to be wrong. Using vertical spreads can allow you, with much less risk, capture similar moves if you set it up correctly. So for example, what I've done now is I have created an OptionStation Pro. I showed you here the options chain. These are different Apple options, but now I'm going to go down here to manage, and you're going to see I have an Apple position in place. So I already did this. I cannot do it when the market is closed, but what I did was I hypothetically bought 10 142 calls, and I sold 10 147 calls. So say, for example, Apple has a good earnings report. Someone might look at the chart and they might say, I think it's going to jump to 147. That's not, that's a sort of level. If you look, you had a low here, and then you have this high here. So if someone is looking for where, how far Apple can move, this could be a place that you would look at to as your first likely sort of stopping point or resistance. So what I did with this strategy was using, a hypothetical account. I bought 10 of the calls, and I sold at the 142s, and I sold 10 calls at the 147. And by doing that, what it basically means is if Apple jumps to 147, I will essentially be able to buy the stock for 142, and then I'll be forced to sell the stock for 147. So I essentially buy for 142, sell for 147, boom, $5. And that's per share, per contract. So each contract controls 100 shares. So in that case, you'd pay $2 per share, and you would collect $5 per share, which is a potential profit, 150%, from the stock moving about 6% to the upside. So that's the kind of leverage that you can get with it. If it remains under 142, the entire thing becomes worthless. So that shows you for $2 per share, that is essentially your risk per share. In this case, what I did was, because I did 10 contracts, it will show my cost as being $2,000 because each contract is 100 shares, and then I did 10 of them. So it costs a hypothetical 2,000, and it can make a hypothetical 5,000 for a profit of 3,000. It can return, it can, the maximum value it will inflate to is 5,000, which is a $3,000 profit, or 150% based on the outlay. So that is the way a vertical spread would work. Now, I cannot do it right now with the market being closed, but the way a person would do this would be to go to vertical, and then you look at how wide it is. In this case, you can see it's set to one. I have it set to 5 spread, to 5 wide. That's how many strike prices Apple has in this expiration. It has contracts at every dollar, at least the ones that are near the money. So in this case, you're going to see that it's 5 wide, which is basically going to be a $5 spread. And you can see, when I entered it, I paid $2, and now it's down to like 138. So I just did it earlier in the day when Apple was higher, but you can already see the kind of leverage and how much value it would have lost. The thing, though, is the same thing works to the upside. If the stock had gone up, it could have appreciated 30 or 40% from the stock moving probably 1 or 2%. On the day. So that's the kind of leverage you can get. And the thing about something like vertical spreads is, the key thing is, for earnings season, when you have binary events and stocks make big moves, basically it's a way to manage risk very simply. The next one is the covered call. Now, this is a kind of an opposite case. And in this case, I'm looking at ExxonMobil. ExxonMobil had a good pre-announcement recently. Energy prices had an interesting rally last week. They're still down significantly, but they've been starting to move higher again based on this idea of OPEC not increasing production and extremely tight inventories and issues like that. So anyway, say you had bought Exxon at 90, and here it is up around 98 or 100. And say they reported earnings soon. In this case, they report on the 28th. Both of these examples I chose for the week of the 24th. Well, actually, the 28th is the expiration. That's Friday, October 28th. So both of these I selected just to make it simple. Apple and Exxon, they report the same week. So say, for example, a person had been long something like this. So now we're looking at Exxon. And if we go to manage, you can see my position on Exxon. In this case, I did a hypothetical 1,000 shares, and I did 10 calls. So in this case, the cost would have been 97,000, and then I basically brought in 8,600. So what this does is this reduces the value I have at risk. Now, the thing about using the covered call in this way is that what it does is it reduces your potential risk to a limited extent. So if you have a stock that maybe had a good rally before earnings, and you say, you know what, I'm afraid of it pulling back a few dollars. I want to lock in what I have. By doing a covered call, what you essentially do is you fix an exit price, and there's a certain point to which you will not lose money. If it drops a lot, then the calls you sold go worthless and your stock starts losing money. In this case, for something like Exxon, I have here the $90 calls. The stock is currently around $98. So it can drop all the way to $90, and it doesn't really matter, because what will happen is the calls that I sold, and I sold short, will lose value. And if you sell them short and they lose value, you make money on those, and that offsets the loss on the stock. But there's more to it than that, because in this case, the options themselves, if we actually look now, I'm going to go to options. This is how you maneuver, just so you realize when using OptionStation Pro. You maneuver with these tabs on the bottom. Go to options. Now I'm going to go to single so you can see again. These 98 calls, I'm sorry, the 90 calls. Look at the wrong strike. You can also control the navigation right here. So these calls at the $90 area, even though the stock ended around the bid and ask is off slightly on this, but basically these calls have extrinsic value in them, which means that they have extra time value. And you can see that by adding this column of extrinsic value. So what happens is as we get closer and closer to earnings and closer to expiration, the time value in the options will decline. So by selling the calls, you automatically collect about an extra dollar of time value. And what's interesting is the time value is higher the closer you're going to the money, but at the same time, you have less downside risk because, I mean, you have more downside risk because if you were to sell something like the 95 strike, then you can only endure a drop to 95 before you start seeing losses on the equity. So the thing about doing a covered call is it allows you to reduce your actual directional risk to the stock. It allows you to collect some premium. Now, the other thing is that when a company reports earnings, the premiums drop after the binary event of earnings. Let's actually take a look at Exxon. You can see down here, we have our implied volatility. This shows how much value is in the options. Look at a company like Pepsi that reported earnings today. You can see the implied volatility was rising before the earnings report. You're going to very likely see in the coming days, this will start going down again because after the earnings report, the options will lose implied volatility. So this, what essentially happens is the implied volatility is higher before earnings and then it declines after earnings. And when that happens, the extrinsic value in the stock diminishes. And that in turn is something that you can capture by selling the calls. By selling those calls, you're collecting some time premium. And then you are also hedging against a drop. So those are the two potential benefits of a covered call. Now, there are two drawbacks. The first drawback is if Exxon goes to 120, you're not making anything more on it. You've capped in the upside. The other drawback is if the stock goes to like 50, you're not protected against a drop down to those sort of levels. However, if you have a situation where maybe you're long a stock, it rallies right before earnings, and you want to limit some of the risk, you can sell calls that are a few dollars in the money. You can capture that time value, and then what you can do is you can lock in a lower price as essentially your the price where you have risk in the stock. Now, another way to see that is by looking, let's go back to manage. And what's interesting is if we look at this, this will tell us, I have something here called delta. Now, delta is the actual number of shares that the position represents. So if I have 1,000 shares of Exxon, that has 1,000 delta. But if I sold 10 calls, those calls had roughly 83 delta, which means one of those calls, if we go back and look here on options, one of these calls has a delta, it says 0.84. So that means if the stock moves $1, these calls will move 84 cents. So if I sell the calls, then I have a negative delta. So what I've essentially done here by doing this is I have 1,000 delta from owning the stock, but then I also have eliminated 835 shares. So I'm really only long the equivalent of 165 shares right now of ExxonMobil. So the thing is what I've essentially done is I've reduced my directional risk without selling the stock. So that is a way that you can think about something like covered calls. By looking at the delta, it allows you to see how much actual directional risk you have. And by looking at options and you get the extrinsic value, you can actually you can see the amount of time value that you have. And as expiration approaches, this extrinsic value will actually decline. If we actually look at something expiring this week, you're going to see that these have, let's look, for example, at like the 98 strike. These have, I mean, that's right at the money. Those have $1.24, but these have 337. So you can see that there's much less extrinsic value the closer you are to expiration. Something like the 90s expiring this week only have 4 cents of time value. The 90s expiring on the 28th have $1.02 of time value. So you're capturing that time value with a covered call. So that's the kind of way to think about it. You want to be looking at the extrinsic value and you want to be looking at delta. Those are the key sort of indicators you want to use to understand this approach. The other thing I wanted to just mention is that if your Option Station Pro doesn't look like this, and for a lot of people it will not, what you can then do is you can go to settings, and then, wait, wrong thing. You go here to this little gear, you go to customize columns, and you can then control which columns you see using this little wrench. It's interesting, I actually clicked on one. I forgot it would do this. It actually shows the value of these Exxon calls. You can see how much they moved. It's pretty cool. A lot of people don't realize that the TradeStation actually can chart the price history of options. It's a pretty interesting a feature that is kind of built into our system, and it's also the result of me having this symbol linking in place. Okay, so that just explained the vertical spread. Long options near the money, short option farther from the money. Being long call, doing a call spread is essentially a bullish direction. The exact opposite with puts. It's a question of long near the money, short further from the money, same expiration, same number. But the way to make it simple is to use the option chain and go here to this actual vertical, and then it will build it for you. And that can save a lot of complication. Actually, one other thing I wanted to show you, if you go to manage, what I can now do is I can drag this into this, and I can actually combine it, and it will show me a combined position. So for Apple, it shows I have these two. If I drag this up into this, it will now tell me I have a vertical, and it basically will portray it and show it as a single position, and you can kind of see it like that. I want to just tell you that's another little feature that's built into this section of OptionStation Pro. So just really quickly, vertical spreads can control up or down moves between two price levels with predefined risk. It can make them potentially useful during earnings season, helping traders reduce significant risk of being, quote, wrong with a binary event like quarterly results. And then the covered call, basically, there needs to be an existing long stock position, one call contract for every 100 shares. And, say, for example, you just want to earn premium. You can sell something closer to the money because it has more extrinsic value, like I showed right here. The ones that are closer to the money have more extrinsic value, and therefore they're going to have more time value, and those are going to see. We look closer to the money, you can see these have more extrinsic value. That allows you to collect more premium. If you simply want to be hedging against a pullback, you can sell in the money calls to basically lock in your current price level or lock in your gain. So you sell in the money calls to reduce directional risk. These benefit from premiums falling after the binary event of quarterly results. All right, those are the main things I wanted to cover. It's great to be with everyone again. Let me just remind everyone that the main thing we are really looking at today was this new tool that we've now released to all customers and included as a basic part. It was always available, but now we're making it pre-built in TradeStation. This next earnings date studies in RadarScreen. It's called Next Earnings Date RS. You may or may not see version 1 with yours. And then it will also pop up over here as, in this case, it's going to be called Next Earnings Date Studies, just Next Earnings Date. And you want the one that has the little logo of I'm not even sure what this little logo is. It has these lines, but then this one, this kind of blue and gray one, that's the one you want to look for. I have some other previous versions we were creating on actually building this that are still in my TradeStation, but this is the one you want that has this little icon. All right, let me see a question. I have a question. Are you in the money for covered calls? Well, all right. So I think your question is for the covered calls where you're doing in the money, and essentially the example I was showing you for ExxonMobil was in the money covered calls, and if you want to be locking in gains, I mean that's like one stock that actually has rallied in the last few weeks with the market down. That's the reason why I chose the example of Exxon. Is this tool for TradeStation 9.5? I don't think so. Make sure. Okay, those are all the questions. I love the question about VWAP, and it is something that stay tuned because I have been working on something with that. So the implication volatility, I think you mean implied volatility, is only to be used with options. So this thing called implied volatility is what it stands for. All options is an indicator. I've included it in the chart. You can do it yourself. And what it's going to do is it's going to approximate. TradeStation calculates the implied volatility of all the options, and it then disseminates that value for each underlier. So a company, I don't know, like Tesla, that's more volatile, it has an implied volatility, over 70, and then a company that is, more stable, just a slower moving company that wouldn't be, I don't know, something like Travelers or something has a, like a 25% or, implied volatility. So that's essentially what it's for. The reason I wanted to show this to you was just to demonstrate that implied volatility tends to increase before earnings. And it can also mean Travelers reports earnings soon, which is why their implied volatility has been rising. You'll see this, that the implied volatility will rise on stocks going into earnings. So it's just a useful little thing to help you when you're picking some of the, when you're looking at some of the option strategies. So yes, the answer was the implied volatility is just for stocks. The one thing I'll add though is that sometimes looking at implied volatility can be useful because, especially for things like biotech stocks, sometimes when they have an event coming up, you'll actually see the implied volatility increasing. It can sometimes kind of give you a clue that there could be some kind of thing coming out, like some kind of data, drug trial or something like that. All right, great to be with everyone. The next webinar is going to be in November. I don't have the date. We'll be disseminating that soon, but it's great to be with everyone. Thanks again, and we'll see you soon.